The basics of stock market investing. What is the stock market and why does it matter? The stock market can often seem like a labyrinth of numbers and charts, but fundamentally, it serves as a critical engine for economic growth. At its heart, the stock market is a platform where shares of publicly traded companies are bought and sold. This exchange allows companies to raise capital, which they can then use to expand operations, invest in new projects, or pay off debts. For instance, when a tech startup goes public by selling shares, it can gather the necessary funds to develop innovative products, hire talent, and scale its business. The significance of the stock market extends beyond individual companies. It reflects the overall health of the economy. A rising stock market often indicates that businesses are thriving, consumer confidence is high, and economic growth is on the horizon. Conversely, a declining market can signal economic troubles, affecting everything from employment rates to consumer spending. Understanding the stock market's role helps investors make informed decisions that align with broader economic trends. Key terminology: understanding the language of investing. To successfully navigate the stock market, one must become familiar with its unique terminology. Stocks are essentially shares of ownership in a company. When you purchase a stock, you are buying a piece of that company, which means you stand to benefit from its growth through capital appreciation and dividends. For example, if you buy shares in a well-known beverage company and it performs well, the value of your shares may increase, leading to profits when you decide to sell. In contrast, bonds are debt instruments issued by corporations or governments. When you buy a bond, you are lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value upon maturity. For instance, if you invest in a municipal bond, the city might use your funds for infrastructure projects, and in return, you receive interest payments that can help fund your own expenses or investments. Next, we have indices, which are statistical measures of the performance of a group of stocks. Popular indices like the S&P 500 or the Dow Jones Industrial Average provide a snapshot of market trends and investor sentiment. For example, if the S&P 500 rises, it indicates that the majority of the 500 largest companies in the U.S. are performing well, suggesting a healthy economy. Conversely, a decline in these indices may indicate widespread economic concerns. Market capitalization, or market cap, is another crucial term. It refers to the total market value of a company's outstanding shares and is calculated by multiplying the current share price by the total number of shares. Companies are typically categorized into small cap, mid cap, and large cap based on their market cap. For example, a large cap company like Apple has a market cap in the trillions, indicating stability and established market presence. In contrast, a small cap startup may have a market cap of just a few hundred million, suggesting higher growth potential but also greater risk. Types of stocks: common versus preferred. Investors typically encounter two primary types of stocks: common and preferred. Common stocks are the most widely held and give shareholders voting rights in company decisions, such as electing the board of directors. For instance, if you own common stock in a popular retail chain, you can vote on issues that affect the company's future, such as mergers or changes in corporate policy. On the other hand, preferred stocks generally do not come with voting rights but offer fixed dividends, making them more akin to bonds. This means that if the company decides to distribute dividends, preferred shareholders receive theirs before common shareholders. For example, if a well-established utility company pays dividends, preferred shareholders will get their payments first, providing a layer of financial security. This feature makes preferred stocks appealing to conservative investors seeking consistent income. Investment strategies: long-term versus trading. When it comes to investing, strategies can vary significantly based on individual goals and risk tolerance. Long-term investing involves purchasing stocks with the intention of holding them for several years or even decades. This approach is grounded in the belief that, over time, the stock market tends to rise despite short-term fluctuations. For instance, an investor might buy shares in a renewable energy company, anticipating that as the world increasingly shifts towards sustainable energy, the company's value will appreciate significantly. In contrast, trading involves making frequent transactions to capitalize on short-term market movements. Traders often rely on technical analysis, using charts and patterns to make quick decisions. A day trader, for example, might buy shares of a tech stock in the morning and sell them by the afternoon, aiming to profit from small price changes throughout the day. While this can yield substantial returns, it also carries higher risks due to the inherent volatility of stock prices. Another critical distinction in investment strategies is between value and growth investing. Value investing focuses on purchasing undervalued stocks, those priced lower than their intrinsic value, with the expectation that they will eventually rebound. For instance, an investor might identify a well-established company that has temporarily fallen out of favor due to market conditions but has strong fundamentals and a robust business model. By buying shares at a lower price, the investor hopes to profit when the stock returns to its true value. Conversely, growth investing targets companies expected to grow at an above-average rate compared to their industry peers. These stocks often come with higher price-to-earnings ratios, reflecting anticipated growth. For example, an investor might focus on a tech startup that is developing groundbreaking software solutions, betting that its innovative products will lead to significant market share and profitability in the future. While growth stocks can offer substantial returns, they also carry a higher risk, as their success is often contingent on continued innovation and market acceptance. Tips for beginners: building a strong foundation. For those new to investing, the journey can appear daunting. However, adhering to a few fundamental principles can create a solid foundation for success. Risk management is essential. It involves understanding how much risk you are willing to take and diversifying your investments to mitigate potential losses. For example, instead of investing all your money in a single stock, consider spreading it across various sectors, such as technology, healthcare, and consumer goods, to reduce risk. This way, if one sector experiences a downturn, the others may remain stable or even thrive, balancing your overall returns. Diversification is a strategy that involves investing in a variety of assets to lower the overall risk of your portfolio. By diversifying, you can protect yourself against significant losses in any single investment. Imagine a portfolio that includes stocks from different industries, bonds, and even some real estate investments. If one sector suffers, say, the energy sector due to falling oil prices, your investments in technology or healthcare might still perform well, helping to cushion the impact on your overall portfolio. Another practical tip for beginners is starting small. Many new investors feel pressured to invest large sums of money, but this isn't necessary. Many brokerage platforms allow you to buy fractional shares, meaning you can invest in high-priced stocks without needing the full amount up front. For instance, if you want to invest in a company with a share price of $1,000, you could buy a fraction of a share for as little as $100. This approach allows you to learn and gain experience without exposing yourself to substantial risk. Additionally, educating yourself about market trends, economic indicators, and company fundamentals can significantly enhance your investment decisions. Resources such as financial news websites, investment podcasts, and online courses can provide valuable insights. For example, following economic reports like GDP growth rates or unemployment figures can help you understand the broader economic landscape, informing your investment choices. Conclusion: your journey into stock market investing. Understanding the basics of stock market investing equips you with the tools to make informed financial decisions. By grasping key terminology, differentiating between stock types, adopting sound investment strategies, and following practical tips, you can build a strong foundation for your investment journey. Remember, investing is not just about making money. It's about growing your wealth over time and achieving financial independence. Whether you choose to invest for the long term or trade actively, the knowledge you gain today will serve you well in navigating the complexities of the stock market. With patience, diligence, and a commitment to continuous learning, you can turn the stock market into a powerful ally in your financial journey.